Friends, welcome to Sanjeev Gupta CPA office. Once again, I want to remind you guys all that we have a live seminar coming up just in a couple of weeks. So Sanjeev ji will be there whole day long there, so you can welcome to come down there. Sanjeev will discuss all sorts of strategies that you can apply to reduce your taxable income in 2018. So definitely, if you have not registered, please go to sanjeevcpa.com and register right away. Now, Sanjeev ji, in today's video, I want to talk to you a little bit about which Obama administration called high wage earner. Though those people don't really fit so much California definition these days. But I mean, let's just say if somebody's making over $200,000, what sort of things they can do to reduce their taxable income in 2018?
Yes, so we're going to talk about a lot of changes that's happened in 2018. That's going to happen in 2018. One of the areas for high wage earners, which you said 200, I will suggest that people making more than 250, 300K, maybe higher is what I believe is a high wage earner.
Okay.
So for them, they can do a lot of strategies. Few strategies which I can say right now is maybe shifting of income. Means when I say shifting, means they can start looking at gifting their assets to their kids.
Okay.
Now, under the new tax reform, the kids' income will be taxed at the rate of trust rates. So up to like $9,000, they will be taxed at 15%. That's it. So there's a huge possibility of lowering your tax rates by shifting asset. Now, what type of asset you can shift? Like stocks. So if you have high value stocks, for example, Google stocks or Yahoo or Amazon,
right?
Stocks, you can start gifting to your kids, which may be younger, like maybe 3 years old, 2 years old, or older, maybe 15 years, 16 years, 17 years, or 18 years. In fact, up to 18 years you can gift. So if you gift them, you can give up to $15,000 every year. You can gift. So when you transfer the stock to the kids for $15,000, that's the kid is 17 years of age. And after he or she holds the stock for, let's say, 2 years, it becomes he or she becomes 19 years, and he or she sells that stock. There will be long-term capital gains, and she will not be paying any taxes. If you were going to sell those stocks, you have to pay long-term capital gains, which will be like high wage earners, about $470,000. Your bracket will be 20% plus 3.8%. Plus your California tax will be another 10%. So you're paying around 32.8% tax versus your kid's tax, which might be 0 or it can be 15%.
So there you go. That's a great strategy you can implement right away if you definitely have a.
And this is the time to start looking at that prospect of shifting the assets like stocks. Now real estate I will not suggest. Stocks definitely. On other things like mutual funds, you can start shifting to your kids. That's one strategy. Second strategy is for high wage earners is owning real estate. Now this is I will say one of the only tax reform where they have put emphasis on business owners and real estate.
So Sanjeev ji, I want to ask you a little bit more about this. So some people are saying, technically speaking, now that mortgage interest deductions are limited to only $750,000. Most homes in the Bay Area are $1 million or above. So they think investing in real estate is no longer a good strategy. Why do you say it's still a good strategy?
Very good. See, what the new tax reform has done is they have shifted they want people to invest in real estate rather than own the real estate and live in that real estate. So there's a difference between investing and owning and living in that principal residence. Of course, there's $750,000 limitation on the loan, and that on the interest that you can deduct on the loan. But if you're owning a real estate and you're into real estate, means you're running the real estate, means you're owning, managing the real estate, and you can prove that it's active income, active business, you're managing it, putting more than 750 hours in a year. If you can prove it, or you have your spouse get a real estate license, that it shows that you're running the real estate as a business, that 20% of your income every year from that real estate you don't have to pay any taxes. So that never has happened earlier. But this is what the opportunity has come up for people who are investing in real estate to look at the real estate from the business angle, not from the just owning the real estate and just putting it as passive income. So that strategy also people can start looking into it for high wage earners. So there's no So you can take 20% off from the of the income that you pay no taxes. So these are few strategies which you can look into for high wage earners.
So, friends, just to kind of put your little perspective here as to what Sanjeevji is talking about. So let's just say you were a high wage earner, like Sanjeevji says, maybe 250, 300K a year, and you're investing in your 401K. So it gives you roughly about 18,000 for you, 18,000 for your spouse, or $36,000 you get to write off. And then maybe you write off another $15,000, $20,000 in capital gains by transferring some of your assets to your kids.
Right.
So that's almost $60,000. And let's say you earn between $70,000 to $80,000 out of real estate, and you can once again write off almost $15,000 to $20,000 off that. I mean, you're literally taking off your deductions at $80,000. So from $300,000 income, you're down to only 220.
20K, if you can plan it properly. That's the buzzword. Planning is very important. That's why we have this seminar where we can bring all those factors in. We can explain this in a better way, and we can interact with the people because a lot of times I also come across a lot of questions from a lot of people, clients basically walking in there asking all those questions, and they're so confused because the tax reform is a huge reform.
Right. I think, Sanjeevji, if we were to tell viewers some idea as to, just like a couple of these strategies you discussed, how many more are we going to discuss at the
Well, there are a lot of strategies for business owners, particularly S Corp, C Corp. People want to start their businesses. They don't know what to do, where to start, whether to do sole proprietor, when to convert to C Corp, when to convert to S Corp, whether LLC is better than S Corp, which state is better for incorporating their business. And we're also going to talk about foreign income, foreign assets, which is also one of the area of reporting requirements.
So there you go, friends. You guys kind of have an idea as to what you can expect at the seminar. So obviously, it's going to be a full-day event. There's nobody else there, so whole day about taxes and tax strategies. We are not talking about so much about 2017 at this point. It's all going to be about tax planning for 2018. So what a great time to start your year perfectly this year. So regardless of whether you do taxes through our firm, you use maybe some other tax professional, or maybe you're using some online tool. Regardless of that, please do come to the event. It's only $15 to come. That covers the venue, and obviously our food is there as well. So you're already taking care of that. Seminar starts at 10 o'clock sharp,
right,
and it's up to 3 p.m.
2:30.
Around 2:30, 3 o'clock. So you got roughly about 5 hours. So maybe Sanjeevji will talk about for a couple hours, and after that he will have plenty of time to answer your questions. So bring your notebook, bring your pen, and be ready to write down tons of strategies. So this is a great year to do your planning and pay the minimum tax possible and make the most money.
And make the most money.
All right, we look forward to seeing you at the seminar. Thank you.